Welcome to a video update with Sean Hickman. Sean, interest rates. We saw New Zealand lift their interest rates again last week, the second lift in a number of months. Some commentary out of Europe, in particular the UK, that interest rates may be lifted quicker than expected. What impact does this have on Australia and the broader global markets?
I think quite a lot, Dave. Our market has been held up here by purely the interest rate differential. Half of our stocks, just about, are being held up as a quasi-bond. People are buying them purely for yield. They think they can't lose. I think it's going to be a really, really bad ending to that whole carry trade, as it's referred to in the trade. So I don't like it. It scares me. So if the UK are talking about raising rates, I think the phrase was sooner than the market expects. Obviously the rest of Europe's on negative rates. That's a real wild card, and that's why one of the reasons why the banks got the most recent push. CBA a couple of bucks. New Zealand's raised rates here probably going to go nowhere. But if rates around the world start to edge up, the risk starts to go up. The US 10-year note, I think, will go up to 3.5%, or 10-year bonds, sorry. This sort of stuff will put pressure on the VIX. It will put pressure on the carry trade. It's a technical way of unfolding this, but if people can buy bonds, or they can buy banks that are paying a higher dividend yield, they're going to buy the banks if they can cover themselves to the downside. That cost of cover to the downside could very rapidly go, and then the banks will come back, and they'll come back fast. In my opinion, 10% from whatever level, I'm not quite sure. So to me, it's the last bit of the party, and the banks will pull back, I reckon, 10%. Most people think I'm mad. Let's wait and see.
Okay, and I mean, we're talking about interest rates. There's press this week saying that the banks will look to take money or borrow money from offshore at cheaper rates. Is this why the banks will go down and why the yields will be impacted?
Well, the banks are loving this environment. They are in the perfect eye of the storm. It could not be better for them. They borrowed banks last week, ANZ and Classic one, I think about 1.6, 1.7% for an enormous amount of money. And then they can lend it out much higher. So it's fantastic for them. They're printing money. The people that are in real trouble are the people that are living off their cash savings. They're going to see over the next 3 months the term deposit rate is going to go down and down and down, and that's going to hurt them. So it's not actually good for part of the economy where people don't take on risk, they just live off their cash. I'm afraid those guys are having a really, really tough time. So again, banks are not being priced on earnings going forward. They are being priced on a yield differential. Rates are low. If that rate just starts to edge up, which it is in New Zealand, talk about it in the UK, it definitely is in the US. It starts to just spill over a bit here. You'll see people run away for that carry trade so quickly that it will come down hard. And we've seen what happens when people run away from the market in mass panic. We saw that with Fortescue, down 35% before today's fall early. We saw that with Flight Centre. When everyone is on one trade and they try and get off that trade, it will fall very, very fast. It will fall too far, and there'll be great opportunities there. And that's the opportunity I'm waiting for.
Excellent. Look, thanks for the detailed update. I think it's something that people always look for clarity on.
It is a hard one to get your head around. It's a hard one, to explain, and sometimes it's a hard one to see how far they're going to push it. At the moment, I'm wrong how far they've pushed it. Let's see if it comes back into reality.
Thanks, Sean.
No problem.